travel.
Passport.
I don't get it because in my email you should already get. And then they check your name. Maybe not check even. Because me down they receive more from this staff email.
Hey, look, man, don't go. If you hear so, let her be for man.
When are we starting?
You alert me.
Was that next?
Okay, so welcome to the Smart Money Talk. It's a live and interactive session on Facebook. We bring you various topics pertaining to personal finance and retirement planning. My name is Mimi, and today I'm here with Ernest Atima and Nanari Afe. Welcome, guys.
Thank you very much.
Thank you.
We'll be answering various topics pertaining to personal finance management. So do well to leave your questions in our comment section. If you have any comments that you also want to leave behind for us, we'll be pleased to have that. So just leave that in our comment section. So we are going to be reviewing the sessions we've done so far and some of the questions that came up, and basically answer all your questions and help you to be able to start your journey towards achieving your financial peace of mind. But before I continue, 2020 has been quite an interesting year. We least expected some of the things that have happened this year. Nana, what have been the lessons you have taken from this year so far?
So far, the key, lessons is, it's good to plan, but then whilst, you plan, you have to make provisions, for outliers or disappointments. One other, key, lesson, perhaps relating to what we've been doing, thus far, is the best time, to invest, like they say, is 20 years ago. The next best time is now. If you check all over the world, great wealth indeed has been built during period of uncertainty. And I hope we don't miss, this opportunity. So look at the key lessons.
Okay, thanks, Nana. Ernest, how about you? Well, what are your key takeaways from this whole, situation we find ourselves in?
For me, I think that COVID has made us aware of the fact that we are actually dynamic than we think, because we've realized that just within a short space of time, we've been able to adjust to a new way of life. You see everybody with face masks. We are trying to do the unusual things now, and that seems very normal to us. We are being forced to stay at home, even when we actually want to go out. So, and we find dynamic ways to actually live as individuals. And so for me, I think that we are actually dynamic than we think. A lot of times we think, I can't change, I can't adjust. But COVID has shown us that indeed, when we are pushed to the wall, we can actually do different things than we think. So for me, that's a key takeaway from COVID-19.
Thank you, Ernest. And happy birthday once again.
Thank you very much.
For me personally, this whole season has given me, and I'm sure other people, the time to sit back and really assess what is important. And for some of us, we've realized that we haven't really, pushed our resources where we need to push it the most. So it's caused us to rethink and reassess and re-strategize to make sure that after this season, God willing, we are better than we used to be before all this started. And it's interesting to note that we started the Smart Money Talk right in the middle of the lockdown. And as Ernest said, this pushed us to do something new. And we started a Smart Money Talk right in the middle of the lockdown. The purpose for the Smart Money Talk was to help you navigate this season we find ourselves. And as this, we believe in partnering you to be able to achieve financial peace of mind. So when all this happened, we thought it wise to be able to have a program to share with you some tips on how to navigate this season. And we started with budgeting, or how to survive the COVID-19 pandemic, with emphasis on budgeting. And this was because obviously COVID-19 had messed up businesses and people's incomes and all that. And there was a need to sit down and rethink what we spend on and what are the most important things. And so during that session, we really mentioned that budgeting is a spending plan, and basically telling your money where it should go instead of you wondering where it went. And we share a few tips on how to budget effectively during this season. So we mentioned that you have to list your income, every income you're going to earn, or any savings that you are going to be able to fall back on. It's important for you to list that. List every expense. Don't leave anything untouched. List every expense. Also categorize it into want and need. And we mentioned that wants are anything that you can do without, like gym membership, eating out. Those are things that you can do without. We mentioned needs. Needs are things that you need to survive. So we mentioned the need to categorize your expenses into wants and then needs. Look at the wants and how much you can cut your expenses by in that category. And we mentioned that if it's possible, and especially if your income has really been affected by this COVID, you want to do away with your wants and focus on your needs. We also mentioned the need to save or put something towards your emergency fund. And this had a lot of interest. A lot of you wanted to know more about emergency fund. And that is what we treated in the next session. The second session, we spoke about what an emergency fund is, and we mentioned that it's basically some pool of money that you set aside to cushion you against life's unexpected emergency. And some asked, how much do you need to have saved? And we said mostly or averagely, the rule of thumb is 3 to 6 months of your living expenses. However, this may be dependent on your own situation. If you are someone who earns an irregular income, you may need more than 6 months. If you're a government worker and you are sure that your salary is secure, you may need less than 3 months. So you may need to do a risk assessment and see whether your income, is at risk or not. And that is what we discussed. The following week, we spoke about investing during uncertain times. Nana, can you share with us the key lessons from that session?
So like I said in my introduction, there's no better time to invest than today. So whatever is happening around in terms of the pandemic shouldn't hold you back. If you need to invest, by all means, go out there and invest. So I would use a typical example. When this whole thing, blew, off, the market in developed market, when I say the market, the stock exchange in the USA, fell to an all-time low. As we speak today, there's an over 40% recovery from the low in March. So can you imagine, if you were in that market and had sat on the fence? In Ghana, we've seen, yields, increasing. And since most of our investments are in Treasury securities, if you had sat, back, you may have lost from the recovery in yield, i.e., the increase, in yield. So there's no better time to invest, than today. If you need to invest, don't sit back because of COVID, because I dare to say people are making a lot of money, and you should be part, of those people who make money within this uncertain period. Thank you.
Okay, thank you. I think that is a very important, takeaway from this season. And if you fail to plan, you plan to fail. And it's difficult times that will reveal some of the financial decisions you made in the past. So let's take this opportunity, if you've not started, to start saving or investing towards your future now. Okay, another thing we spoke about because of Nana's session was the need to set effective financial goals. We mentioned that financial goals are desired outcomes that we need money to fulfill. So if you want to get married and it's going to cost you money, that is a financial goal. If you want to retire comfortably, that is definitely a financial goal. We mentioned that to be able to set financial goals, it's very important that you look at your life, what it is you want out of life, and be able to put a figure to it. If it's a house, if it's a car, if it's whatever it is that you want, and whatever desires you want, put a figure to it. So with a financial planner, you can be able to forecast how much this would cost me when I need it. And you also have to make sure that, your goals are smart. For most of us, we just set crazy goals, so we never achieve them. Smart means specific, measurable, attainable, realistic, and time-bound. Ernest, you also mentioned something very important in the next session, and it was about a magic number, something that we should all be concerned about. Can you tell us more about that?
Yeah, that magic number is actually what we call your net worth. And then we established the fact that it's the most powerful indicator of your financial health. And at this time, one thing that you want to do as an individual is to try to know where you stand financially. And that's what net worth actually seeks to do. We established that net worth is basically the difference between the value of what you own and then what you owe. And we went ahead to also state the fact that net worth is the most accurate way of determining our wealth, because a lot of times we only focus on what we own. But in determining how much you are worth, we need to go a step further by lifting up the veil to see the liabilities that we are also carrying as individuals. And that's what net worth actually comes in to do. And one of the other key things that we learned was that we need to focus on assets or things that appreciate in value as a way of building our net worth. So a large proportion of our income shouldn't be going into things that will go down in value with time. But if we really want to improve our position financially, then it's important that we try as much as possible to spend more on the things that appreciate in value. And I think one of the final things I said was that money is very important, but more money doesn't necessarily solve our problems. It is how best we manage money that helps us to actually achieve financial peace of mind. And so in a nutshell, this is what we learned from last week's session.
Okay, that's great. So if you want to know more about all these sessions, they are on our page. You can go back and re-listen, make notes, and do some adjustments if you think you need to. And we want to address some of the questions that we were unable to address in our past sessions. And if you have any questions, do well to drop them in our comment section, and we'll have all the time to answer those questions for you. So we'll start with a few questions we have here. Okay. So someone asked, Samson AJ Quatin asks, can you recommend any books about effective financial goal setting? So we have 3 books we want to recommend today. We have Financial Fitness by Chris Brady and Oren Woodward. And it has a workbook attached to it that would help you in your financial planning process. So if you want a book on setting goals, this is a good one. There's also another one, Millionaire Next Door. I'm sure a lot of us have heard about it, and it's by Thomas Stanley. So you can also look at that one. And we have Your Money, Your Life by Vicki Robin. So these are a few of the books that we want to share with you. Okay. Ernest,
Yeah.
Amma Baxton asks, how do I approach my net worth in these COVID times? How do I approach my net worth in these COVID times?
I think COVID-19 has brought a lot of uncertainty to us. Day by day, we wake up to increasing numbers and we begin to wonder, when will this ever end? But as far as your net worth is concerned, the least you can do in these times is to try as much as possible to at least maintain what you have accumulated so far. This is not the time to focus on luxurious life. This is not the time to focus on your wants. It's actually a time to focus on your basic needs. Like I said, we do not know what we'll wake up to here. And so you'd want to preserve what you have accumulated so far. And I must add that for those of us who have been blessed to still have our jobs and our salaries intact, this is the time we need to increase our investments. And this is because even though generally prices of goods have gone up, you could also see that in terms of how much we spend on fuel, those who drive has relatively gone down than before. There's less traffic on our roads. You can actually make some savings. And for those of us who even work from home, it becomes better for us. All that money would have allocated for fuel, we can actually use it to augment our savings. And those who like Friday nights and pubs and all those things, you realize that now you can't do most of these activities. And that's a good way for you to actually save some money to increase your net position. I would also want to add that if you do not have need for money, do not draw down on your investments at this time. It's very, very important. And as much as possible, let's avoid accumulating more debt in these uncertain times so that at least what we have, we can be able to carry through. And in the event of any bad news, at least we'll have something to fall back on, because that's the whole essence of having your net worth being in the positive. If it's good, then it means that if you have any financial setback, you will still have some cushion. And so in a nutshell, I'll just say that let's try to maintain what we have accumulated so far. And if we have any windfall along the way, let's try and augment our savings. And that will help us to have a good position in these times.
Yeah. Thank you, Ernest. Nana Fauzia Idris is asking, How does mutual fund work? How do they work? How do mutual funds work?
Okay, so that's an interesting question, Mimi. I would want to define what mutual fund is before I address how it works. So mutual fund is simply an investment vehicle that pools investment from many investors and then invest on their behalf in financial securities such as bonds, money market instruments, or equities. So those are mutual funds. Basically, what mutual fund does, is it exposes investors like yourself, myself, individual, to the expertise of money managers. It is difficult, taking financial investment decision by ourselves. So what mutual fund, steps in to do is to help us in that process. And it's very interesting. Let me make a point. All over the world, we are advised against self-medication. People go to medical schools to become doctors. And by their profession and training, they are supposed to advise and help us when we fall ill. It's interesting that one particular area of our life, which is so important, as in our financial life, we tend to, i.e., self-medicate. And that really has been, the bane of our financial services industry, and the fact that so much money has been lost to fraudulent schemes because we all think we are smart and we know all there is to know about investment. So that's about mutual fund. Now, I don't have the permission of these firms to mention their products, but some examples of mutual funds we have out there on our market are the Data Bank M Fund, the Data Bank EPAC, which is like the oldest mutual fund out there. There's a Data Bank B Fund, etc. Stanlib also runs a number of mutual funds. I know of the Stanlib Income Fund, the Stanlib First Income Fund. EDC also has a number of mutual funds. So these are some of the mutual funds out there. If you want to learn more about them, you can reach out to this, three institutions I just mentioned, their name, and I'm sure it will be of great help to you. But in summary, mutual fund pools resources together from retail investors or institutional investors and then invest on our behalf. The advantage of investing in mutual fund is that you get the expertise of money managers to handle your money well. Thank you.
Okay, thank you, Nana. Thank you, Nana. So Pearl is asking, how long should an emergency fund last? And we've mentioned that briefly, but I'll go over it again. So the rule of thumb is that you should have 3 to 6 months of your living expense stacked up in an emergency fund. What that means is that should you lose your job, at least for 3 to 6 months, you should be able to survive while you're looking for something to, get back onto your feet. However, this may differ from person to person. If your ability to earn as an income is at risk, that means that you have to have probably more than the 6 months. For example, if you're an irregular income earner and you found yourself in this COVID situation, as soon as the president says there's a lockdown, probably maybe you sell something or you do something that is while you're looking, your income will be cut short there and then. And then you need an emergency fund to sort you out. Unlike the salaried worker who would probably have their income, even if their company were to be affected, will probably have their income for maybe a month or two before they are hit by this. So your risk, how risky your income is, how risky it is for you to earn an income, or whether your income may come or not come will determine how much you need to put into your emergency fund. So if you are more risk of losing your income, it's more important to have a bit more stacked up. Also, it depends on your family situation. Of course, if somebody is single and the person may not need that much, but if you are married, you tend to have a bit more emergencies, medical emergencies, and all those things may come up. So that may also influence how long your emergency fund, you want your emergency fund to be able to last you. And one thing that I would also add is what to do with those funds. You can either put it in a current account or a savings account or a money market mutual fund account. But mind you, current account charge, they charge a lot. So keep that in mind. Personally, I wouldn't put my emergency fund in a current account. If you are interested in preserving at least some value when it comes to your emergency fund, putting your money in a mutual fund or a money market mutual fund should be fantastic for you. Okay, Ernest.
Yeah.
Another question from Felicia Asare. Is it right to compare my net worth to another person's net worth?
All right. Net worth is actually an individual thing, and we all have different circumstances that we in our lives actually. So it's not right to actually compare what I have today to what someone has today. And for the reason that you may not know what the individual is carrying as liabilities, you may not know the assets that that individual actually has. The same way, your assets may also be different from that of another person. And so it is not prudent for you to compare. That is why we have an ideal net worth based on your income and then your age. And last week, I remember that I shared the formula for actually determining your ideal net worth. And so I'll just go over again for those of us who were able to join us last week. I mentioned that you take your age and then you are taking number 25, that is 25 out of your age. The reason why we are using 25 is basically saying that on average, most of us started working or earning some sort of income from age 25. And so you take your current age, you take out 25, and then you multiply the result of that by 20% of your annual income. And like I shared last week, we are using 20% of your annual income basically because we are applying the 50-30-20 principle when it comes to budgeting, which states that you spend 50% of your income on your needs, 30% on your wants, and then you spend the remaining 20% on investments or savings. And so out of your annual income, we are assuming that it's 20% of that you can actually invest towards your net worth. And so basically, all we are saying is that you do not have to compare your net worth with another person. Our individual circumstances are different. If you want to have a target or a yardstick, then use the ideal net worth formula to determine what you should be working towards. Thank you.
Okay, thank you, Ernest. Eresi Owusu-Ansah is asking again about net worth. How often can I calculate my net worth?
Okay, so that is usually based on your, should I say, an individual thing, but experts across the world advise that as often as possible. Some advise monthly, others advise quarterly, semi-annually, or yearly. It's what's comfortable for you. The whole reason why you need to keep assessing your net worth is to know the progress that you are making as an individual. And so if, for example, you think that the actions you are taking now, you will need a space of, say, a year or maybe 6 months to actually assess the effect of your actions, then that is, as an individual, that is your approach to knowing how frequent you should calculate your net worth. But then if you can do it on a monthly basis, because on a monthly basis, you're able to undertake certain financial activities that would actually change or bring an impact as far as your net worth is concerned, then you can actually result to determining your net worth on a monthly basis. So I would say that it all depends on what you are comfortable with based on the actions you are taking. But the more you, or the frequency of you calculating your net worth would help you to know how best you are doing as far as progress is concerned.
Okay, thank you. And still on mutual funds, James is asking, can I change my retirement investment to a mutual fund where I can make partial withdrawal? Nana?
Yeah, Mimi. So that is an interesting, question. But then an interesting question. Mutual funds, can serve varied purposes. There are quite a number of mutual funds, out there. Some of them caters for your short-term need. You mentioned an emergency fund. So there are quite a number of mutual funds that are targeted, towards needs below 1 year. There are also, mutual funds that kind of caters, for the client's long-term investment. So at the end of the day, if you desire, to invest towards your retirement, you just go in for a mutual fund that serves that purpose. Question is also a bit counterintuitive because I heard asking the question, saying, can I move money into my retirement fund to allow partial withdrawal? Why would you want to withdraw money from your retirement pot? What we advise is money meant for retirement should be kept for that purpose, i.e., you don't break a retirement investment for immediate gratification. So we've talked about emergency fund. That is the purpose of emergency fund. If the plan is to invest, towards building a house, you choose an investment vehicle that serves that purpose. To also, go further on a racist, question. Since about 2010, we have licensed several pension funds company, private pension fund company, and Access is a typical example of a private pension fund company. We run investment products that caters, for your retirement need. So I would encourage that if your goal really, is to invest towards your retirement, you reach out and then learn more about our Access Personal Pension Plan, which is meant, to cater for your retirement need. We've also made, that product a bit flexible. So there's the retirement bit and there's the saving bit. So you can allocate part of your investment into the saving bit, which gives you periodic asset should the need, arises. Thank you.
Thank you, Nana. AC is asking, how much of my income should I spend on discretionary and non-discretionary expenses? I think Ernest mentioned the rule of thumb, which is 50, 30, 20, which is 50 on your needs, 30 on your wants, and 20 for investment. That's a rule of thumb. It's a general rule, so it's just supposed to guide you. However, what you spend is dependent on your own goals. What you spend is dependent on your own goals. So as for the 20%, or whatever you decide, whatever percentage you decide to save every month, as soon as you earn your salary, pay yourself first, which is one of the fundamental rules towards achieving financial security. Pay yourself first. So if you agree and you say, okay, you want it to be 20%, you want it to be 30%, you want it to be 40%, pay yourself first. The rest will be for your expenses. Now, how much you decide to put towards your savings is dependent on your goals. That is where you want to be in the future. So if your goals, based on your goals, you need to put aside more money than what is expected, that's the 20%. You can decide to put aside 30 or 40, also dependent on your budget and what really you can afford to do. Remember that you don't want to save at the expense of survival. So it's also dependent on your goal. But once you have determined how much you want to save, whether it's 20%, 30%, 40%, the rest is for spending. It's mostly advisable that you look at catering for your basic needs first, and whatever you have left, you can decide to spend that on your wants. So generically, we can look at the 50, 30, 20 rule, but however, that would be dependent on your own situation and whatever your goals are. Personally, I do more in my investment, so I end up spending less on my wants, and that's because of the goals that I have. So it's important for you to sit down and look at the goals. If you've not developed your goals, start from there. Look at what your goals are, and look at what your basic needs are. As for the wants, they are the last things that you should look at. So once you have these things in place, you can determine what works perfectly for you. Okay, so Ernest, back to you again. Kojo is saying, aside from my car and house, what other assets can I include in determining my net worth?
All right, so last week we established that when we talk about assets, we are talking about what you own. And for the purposes of net worth, we are looking at the things that you own that have monetary value or economic value. And so aside your house, aside your car, you can look at any landed property that you have. Maybe you own a piece of land or you own an acre of land. It's important that you add that to the things that you own. That is, you look at the current value of that land and then you add it when you are determining your net worth. We also spoke about investments. So if you have any fixed deposits, if you have mutual funds, you need to get the current values of all these investments, then you add it as part of your assets. We also mentioned that you can look at your pension accounts and then your provident accounts. In Ghana currently with the 3-tier system, basically we are looking at tier 2 and then tier 3, because for that one, you can readily assess or know the balance standing on these accounts. So that all those things can form part of your assets. And if you take it a step further, you can also talk about maybe some expensive jewelries that you have. If you can properly value them, and if it's readily, it's something that you can readily sell, I mean, in exchange for cash, then all these things you can add as part of the things that you own. So it's not limited to just land, house and car. All other things that you own that have monetary value can also be included.
Okay. So thank you, Ernest, and I would encourage you to keep your questions coming in. And we have a question from Stephen, and the question says, how do you balance your financial goals when you have responsibilities such as taking care of your aged parents who have unpredictable health expenses? That's a very interesting question. And Stephen, is the reason why we advise you to have a financial plan. So what the financial plan does for you is it helps you to be able to state your goals, whatever your goals are. And what we also do is we assess your current financial situation. So we assess where you are at the moment and what are some of the financial obligations that you may have to deal with. And it's based on that we are able to determine, okay, you may need to do A, B, and C to be able to achieve whatever goals that you have set for yourself. So for example, your parents getting, sick all the time means that you may probably have to put aside more money in your emergency fund because you are more prone to have these emergencies. If there's also a way of having some kind of health insurance for them so that they can fall back on that when they fall sick, so that you are not affected. Because the use of insurance is not only to mitigate risk, but it's also to help you preserve wealth. And when there's risk that you haven't paid attention to or that you haven't catered for or have any insurance for, it's likely to mess up with your plan. So if you can also get some kind of medical insurance, even if you can get national health insurance and then also top up with something else, that should be able to, reduce the burden on you. But it's very important that you have a financial plan to decide what these goals are and to decide how long it's going to take to achieve these goals. So for example, if you want to retire, that's going to take you, I don't know how old you are, but that may take you maybe 30, 20, 10 years. That's a long time. So we can start contributing a little at a time towards it. The important thing is to start early enough so that you can have more time and take advantage of compound interest to be able to accumulate something towards your goal. So it doesn't mean that you have to take all your money and go and use it for one thing or the other. Having a financial plan helps you to start early and start planning little by little towards your goal. So that if you know that you need something in the next 10 years, we start little by little, with a little here, a little there, with the help of compound interest. By the 10 years, you have the money, you achieve whatever it is that you want to achieve. So I advise you to talk to a financial planner and get a financial plan in place. We'll look at both your goals and your current financial situation and help you put in place a strategy to help you move from where you are to where you want to be. Okay. The next question, Nana, is about mortgages. We like building a lot, or every Ghanaian wants to have a house, at least if you haven't done anything. One thing most Ghanaians will be proud of is having a house. Someone is asking, and that's Ikia Manta, she's asking, setting a goal to save towards purchasing or building a house or buying a mortgage, which one would you advise? Setting a goal.
Thanks, Mimi.
Or building a house or buying a mortgage, which one would you advise?
Thank you, Mimi. Another great question. I would begin by quoting from the great book in Luke 14:28. It says, "Which of you building a house without counting the cost?" Unfortunately, that is a story of Ghana and most Ghanaians. Completed, building is amazing. If you fly, across the country, you see, for every completed house, there are about, 10 uncompleted buildings. And that is, scary. That is wealth being left, to rot. So it is a good question. You do not set out on a real estate ambition or project without counting the cost. It is very, very important, to underline my answer, establishing that fact. You can't go out building if you really haven't counted the cost. Else you would push all your money into the project and you realize you cannot finish. The question about saving to complete a building and going for a mortgage really, depends on the individual and his income level. If, so much, and you can quickly save money towards a building, why would you want to go, for a mortgage or a debt, which would take you 15 to 20 years in Ghana, to pay off? However, if you are like most majority Ghanaians whose income level is not so big, but then can afford, a mortgage, then I would rather want to go for a mortgage to complete a house or to purchase a house, whilst the money I would have used to pay rent goes to service the mortgage. At least the assurance if going for a mortgage is that after paying for 15, 20 years, the house becomes officially your own. However, if you are paying, rent for the number of years, you are paying rent, you are actually working for the landlord. So first of all, count the cost. If your money, can afford, go out there and then complete it without going, for, debt. If you qualify, for a mortgage and you can effectively, service your mortgage. And over here, my advice is, your mortgage servicing cost shouldn't exceed more than 35, 40%, of your income. It is very, very important, especially in Ghana, where majority of the mortgage companies offers mortgage in dollars because the CD interest rate is just outrageous. The dollar interest rate is reasonable, and therefore, at the inception of the mortgage, the cost, sound reasonable. But given the history of depreciation, if you don't really account, for city depreciation. 2 years, 3 years down the line, you might be seething because of service and mortgage. So count the cost, know how much it's going to cost to complete your house, get a quantity surveyor, get an architect. When you realize you can afford it, do it yourself. If you think you cannot afford it, go for a mortgage. And in going for the mortgage, make sure your mortgage servicing cost does not exceed 40% of your income, and make adjustments for city depreciation if your mortgage is in dollar. Thank you.
Okay, thank you too. Thank you too. So Ernest, a question for you, and it says, just a minute. Ernest, a question for you. It says, I've been tied up. I'm tied up. I've lost a part of my income in this whole COVID-19 pandemic. Would you advise me to withdraw my retirement funds? I'm really tied up, and I'm really concerned about being able to maintain my net worth.
All right. I don't know who the person is, but I just want to say extend my sympathy to you in these difficult times. I can understand it's not a good or a pleasant position to be in, but I'm happy you said that you've lost a part of your income. That means it's not your entire income that you have lost. And given that your retirement already has a goal, and that is for your old age, like I mentioned earlier on, if you do not have need, if you are not pushed to that point, as much as possible, do not touch your investments. And in my earlier submission, I said that COVID-19 has helped us to be dynamic as individuals. And so if the little income you have, it's possible you can adjust a bit of your lifestyle so as not to touch your retirement income. It will really, really help, because old age comes with its own challenges. And as people who want to have good retirement, it's important that we do not rush to touch our retirement. And I think Nana even touched on that in one of his submissions. And so what I would say is that if you are still earning a part of your income, if not all has been lost, then let's try and see if we can readjust our lives and see if it would help us at this point. If need be, then probably we need to do a little more work as to what we can do to bring in other income to help us take us back to the level that we were in. But for now, I wouldn't advise that we go in to touch our retirement. Let's try and rather adjust our lifestyles to accommodate this period that we are in. Of course, it won't be forever, and we are praying that very soon everything would come back to normal.
Okay, thank you, Ernest. So, Nana, this question is for you.
Hi, Mimi.
What are treasury bills and how are they different from mutual funds and fixed deposits?
Okay, good question. So, treasury bills are issued by government. So that is government borrowing, from me and you. The maturities, for treasury bills, are usually short. So in Ghana, we have the 91 days, the 182 days, and then the 364 days treasury bills. The borrower is the government. Now let's go to fixed deposit. Fixed deposits are also, short-term investment avenues for, again, me and you. The issuer in the case of a fixed deposit are usually financial institutions, mostly banks and savings and loans. A mutual fund, what mutual fund would do is a mutual fund would invest in treasury bills, in fixed deposits, in shares, in government bonds. So FDs, that is fixed deposits, and treasury bills are direct investment. The issuers here, like I said, for treasury bills are government. So it is only government that sells treasury bills. For fixed deposits, the borrower or the issuer are mostly banks and savings and loans institutions. And from banking financial institutions that are mandated to take deposits. A mutual fund is a pooled resources managed by professional money managers, which intends invest in financial instruments like treasury bills, fixed deposits, and the likes. I don't know if I've been able to break it down to understand it. So that is about these three investments, instruments, you asked, about.
Okay, thank you so much, Nana. We have one more question. And we have one more question from, okay, another question has come in. What is the ideal ratio or measure of one's net worth after comparing the outcome of one's valuation and the results of the net worth formula? So that's the UNS. What is the ideal ratio or the measure of one's net worth after comparing the outcome of one's valuation and the result of the net worth formula?
If I understand the question, I think basically you want to know what the ideal position should be after you have calculated your net worth. And I think I already explained that in previous question. And I mentioned that there is a rule of thumb that says that your net worth is a function of your age and then your annual income. And so once you've been able to determine your own net worth, the result of that rule of thumb is what you compare your net worth to. If it's less than the value you got, then it means that you have some work to do. If it's more than that, then it means that you are good to go, you are fine. And so for your benefit, let me just give you the formula again. If you have a pen, just write it down. It is your age minus 25, and then you multiply the result by 20% of your annual income. Basically, that's what you should be comparing your net worth to. Thank you.
Okay, thank you, Ernest. Erika Champong is asking, how do I start investing with Axis? How do I start investing with Axis? Now, for Axis, we have an individual pension product called the Axis Pension Plan. This basically helps you to invest towards your medium to long-term needs, really looking at retirement. As Nana mentioned, we have the savings account and the retirement account. So even though this is towards retirement, as the name should tell you, we know that, you may need something in the shorter term. So the Axis Pension Plan allows you to make a withdrawal from your savings account after 5 years. So we have the savings account and the retirement account. The retirement account is towards your retirement. The main aim of that is to make sure that when you retire, you do so comfortably. Unfortunately, in Ghana, only 10.5% of Ghanaian pensioners or Ghanaian workers earn a pension. So it's very important for you to start taking your future into your own hands by contributing to the Axis Pension Plan. You can do so by filling a form and a direct debit or controller form that is dependent on where you work, or you can also use mobile money to contribute as and when you wish to. So you can just drop your name in our inbox and would get a financial planner a pension advisor to help you through the process so that you can start your journey towards a comfortable retirement. We have another question from Justin Addo, and it says, could you recap some of the strategies to reduce my liabilities? How can he reduce his liabilities? Ernest, this question is to you.
All right. So, reducing your liabilities, last week we stated two important things that you can do. The first thing is for you to try as much as possible to borrow just what you need. And so you do not go borrowing for in excess of what you actually need. And your borrowing should be for things that improve your position or things that add value to your assets. And so you do not borrow for things that ordinarily won't bring in any future income if you really want to improve your net worth or reduce your liabilities. And I remember I gave an example that if you are going in for a loan of 10,000 cedis for a particular project, even if your salary can allow you to take more, try and stick to the 10,000 cedis, because a lot of times we are not able to account for the excess, and that is not a good way to approach your net worth. And then I also mentioned that you need to have a strategy to pay off your debt. This is because when you go for a loan and in the course of the loan and you have any windfall, try as much as possible to allocate some to reduce your loan balance, because the truth of the matter is that loans actually reduce how much we have as in our net worth. And so if you want to improve your position, don't always allow your loan tenor to run. If you can pay off, try to pay off, especially because in Ghana here, most of the loan rates are much higher than how much we even get on investments. And so if you have some windfall, you can also have a plan to allocate a part to pay down your debt as you allocate parts to also improve your investments. So basically, these are the two things that you can do to reduce your liabilities. Let me just touch again on the other question about the ratio. There's another thing that says that the ratio of your income to your net worth. There's another bit that says that when you are done calculating your net worth, you can take your annual income and find the ratio between that. And it says that the lower, the better. What that means is that it's only you have a lot of, as far as your net worth is concerned, even though the ratio is lower, you are still able to save more. And so basically what we are saying is that if you find a ratio between your income and then your net worth, the good thing is that it should be lower. If it's higher, then it means that you are not saving more of your income, or your income is not contributing more towards your net worth. So always know that if it's low, then it's better. So you can be measuring yourself in that direction as well.
Okay, thank you. Abuaji Michael is asking, I have SNIT and Tier 2. What other pension can I invest in? That's a great question, Abuaji Michael. As I was saying, we have the Access Pension Plan, which is a personal pension scheme, a Tier 3 personal pension scheme. So under the law, we have Tier 1 and Tier 2 that are mandatory, but Tier 3 is voluntary. So the law has given you, an individual, the power to take your own, future into your own hands and do something towards your retirement. And that's where the personal pension comes in. And Access, we call that the Access pension plan, which I just mentioned earlier. We allow you, or it allows you to contribute something as little as 100 Ghana cedis every month, or as frequently as you would want to, on a monthly basis towards your retirement. And it does really make a big difference in the long run. You're able to save so much than you would have ever thought in the long run. So I'll encourage you to sign on to the Access Pension Plan. Papa K. Asari is asking that how can Access help me improve my net worth? And I'll just take that question because it's connected to what I just spoke about. Access manages pension funds. And as Ernest mentioned, pension funds form part of your assets when it comes to calculating your net worth. So your Tier 2 balance, if you have a provident fund with your employer, that balance also counts. So if you haven't taken advantage of that, you should take advantage of your provident fund if your company allows you to do so, or they are hoping to match you up. Why not take advantage of that? But another way of improving your net worth is taking advantage of the Access Pension Plan or a personal pension scheme, which I just mentioned, and it's voluntary and it's very flexible. So you can sign on to the Access Pension Plan and start with as little as 100 Ghana cedis on a monthly basis. And you'll be shocked at how it would help you to improve your net worth. That is your increase your assets. The good thing is that it compounds on a weekly basis. So every week, whatever you have in your account is making more money for you. And in the long run, you're able to accumulate so much towards your retirement, which also helps you to improve your net worth situation or position, sorry. Okay. There's also another question from Ophelia, and she's saying, great discussion. Can you please do this on national television so that this important message will reach a lot of people? Thank you, Ophelia, for your wonderful feedback. We'll look at it and make sure that more Ghanaians get to hear the good news and start putting in place strategies to ensure that we are all financially secure, which is what Access stands for, ensuring that the Ghanaian achieves financial peace of mind. Thank you, Olivia. Okay, so thank you very much for joining us. We have enjoyed answering your questions, and I hope we've been able to learn so much from these discussions. We'll be continuing next week. There was some question on investments. What is mutual fund? What is treasury bill? And we'll be dealing with that in the future. So next week, join us as we discuss investment basics. We don't want to find ourselves in the situation some of us found ourselves in a year or two ago, where we invested in places we shouldn't have. So do well to tell a friend to join us next week to talk about investment basics. And I hope that we would all be able to invest wisely and to be able to achieve whatever goals we have been able to set for ourselves. Thank you very much once again. Do join us next week, Wednesday at 4 p.m. Until then, continue to keep wearing your mask and keep being safe, keep protecting yourself and your family against COVID. Thank you so much and enjoy your week.
Thank you. It was a pleasure interacting with you.
Thank you, Ernest.